The Home Ownership and Equity Protection Act, or HOEPA, was established in 1994. HOEPA protects consumers against potential abuses in connection with high-cost home loans. High-cost loans are also known as Section 32 loans. Section 32 loans are subject to loan term restrictions and additional disclosures. What loans are subject to Section 32 designation? Let's take a look. Section 32 loan designation can only apply to personal use loans secured by 1 to 4 unit residential property or personal property and used as the borrower's principal residence. Section 32 loan designation does not apply to reverse mortgages, new construction loans, housing finance agency loans, and USDA Rural Development Section 502 direct loans. For loans which are subject to Section 32 loan designation, 3 coverage tests apply. They are the annual percentage rate, or APR test, the points and fees test, and the prepayment penalty test. If the loan passes even one of the above tests, it is a Section 32 loan. A loan becomes subject to Section 32 under the APR test if its APR is greater than the average prime offer rate, or APOR, for a comparable transaction on the same date by more than 6.5 percentage points for first lien transactions, 8.5 percentage points for first lien transactions if the residence is personal property and the transaction is for less than $50,000, or 8.5 percentage points for junior lien transactions. A loan becomes subject to Section 32 under the points and fees test if the points and fees the borrower pays exceed 5% of the total loan amount for a loan of $21,549 or more in 2019, or the lesser of 8% or $1,077 for a loan of less than $21,549 in 2019. The threshold amounts are adjusted annually for inflation. Finally, a loan becomes subject to Section 32 under the prepayment penalty test if a prepayment penalty is charged more than 36 months after the loan transaction is consummated on a closed-end loan or account opening on an open-end loan, or exceeds in aggregate more than 2% of the prepaid amount. Let's take a look at a couple scenarios to see if we can determine if the loans are Section 32 loans. Clarence applies for a $250,000 first lien mortgage for the purchase of his first home, a condo. The APR on the mortgage is greater than the APOR for a comparable mortgage by 2%. He pays total points and fees equal to 3% of the loan amount. The prepayment penalty period will last for 4 years after the close of his mortgage. Is this loan subject to Section 32 designation? Yes, the prepayment penalty duration exceeds the threshold set by the Section 32 prepayment penalty test. Recall that exceeding even one of the 3 Section 32 test thresholds subjects the mortgage to Section 32 designation. Thus, Clarence's mortgage is a Section 32 loan, subject to term restrictions and additional disclosures. Margot applies for a home equity line of credit, or HELOC, of $40,000, which will be secured by her home, a single-family residence. The loan will be a junior lien on her home. The APR on the HELOC exceeds the APOR by 7%. She pays points and fees of 2% of the loan amount. The HELOC does not charge an early closure or prepayment penalty. Is this loan subject to Section 32 designation? No. Margot's HELOC does not exceed any of the thresholds set by the 3 Section 32 tests. Thus, it is not subject to Section 32 designation.